The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome to the Volatility Viewpoint section. This is where Don and I grab someone from the world of volatility and volatility research and force them to answer our questions at gunpoint usually. But today, actually, we are lucky enough to have a really interesting guest. We are joined by Professor Rob Engle. He is the Michael Armelino Professor of Finance over at the NYU Stern School of Business, and I think most of our listeners will be familiar with him through his groundbreaking and pioneering research that won him actually the Nobel Prize for Economics in 2003 for his research into the autoregressive conditional heteroskedasticity model, aka the ARCH model, and his current incarnations as the GARCH model. Professor Engle, welcome to the show.
Thank you. It's nice to be here.
Or should I call you Rob, since we are on such informal terms?
Rob sounds good.
Now, Rob, as we were talking before the show, and we were looking over some of your early research, and as a former options trader myself, I'm familiar with a lot of your research into the ARCH model and later what became the GARCH model. And I was interested to see, actually looking over some of the information for this show, that you actually got your start in the world of physics. The more I mull it over, the more that seems to make a lot of sense, actually looking at your subsequent research into what are essentially time series analysis and volatility, because there is a lot in the world of physics, especially in the worlds of physical chemistry and those sort of things, which I dabbled in before I was also lured into the dark side of finance. Seems to be where you pulled some of your inspiration for your later work into finance. But what brought you over to the dark side of finance from physics?
Well, I think that physics is really has shaped the way I think about finance, because it is. I was an experimental physicist, and you're always trying to figure out what's in the data and what's the theory, and how do you get those to match up? And it's a very pragmatic kind of question. And I think that that's exactly why I've done the sorts of things I have in finance. The way I switched actually was I was in graduate school at physics at Cornell studying superconductivity in the basement of Rockefeller Hall.
I was going to ask you about that, actually, because I am a fellow Cornellian, and you don't see many people coming to Cornell actually for the econ because the physics program is so strong.
Well, you probably experienced the same situation there. So anyway, it was very exciting. I mean, we had great classes. I had Hans Bethe teaching me quantum mechanics and all this good stuff. But I decided that I didn't really want to study something that only 10 people in the world would understand. And so I went across the street and switched into economics. It was a great switch for me, turned out.
It seems we had similar revelations a few years apart at the same place. But the reason we wanted to have you on the show today is, of course, your work with the ARCH and the GARCH models. And I think for maybe some of our newer listeners who aren't as familiar with your work, well, instead of having me characterize it, why don't I have the author of the Nobel Prize winning study characterize it for our listeners? Let's give our listeners a brief overview of your ARCH method and then what led you to some of this research in this field.
Well, the ARCH model is designed to measure volatility when it's changing. And that's obviously a major problem that has faced practitioners for a long time. And there are lots of solutions, things like historical volatilities and exponentially weighted volatilities and so forth. But there is no systematic way of building a forecasting model for volatility. And it actually is potentially complicated to think about how you do that because we never actually observe volatility. We only see its consequences. So how can you build a forecasting model for something that you don't observe? And that's what the ARCH model allows you to do. You can design a statistical approach to forecasting volatility and figure out what the best forecasting model is by looking at historical data. And so you can build a volatility model without using the options data, and then you could confirm it with options data if you like.
Now, I imagine when you first started researching this field, you were probably frustrated with a lot of the early models in this area because a lot of them seemed to rely on essentially a lot of standardized assumptions, and they weren't particularly reflective of how assets and markets tended to perform in the real world. And is that really what got you started down this road? You wanted to make a model that was more accurate and more reflective of the way we saw things actually performing in the real-time markets?
I'd like to say yes, but in fact, that's not exactly what happened. My actual original model was not applied to finance at all. It was applied to macroeconomics, and it was trying to measure volatility not of financial markets, but of inflation. And this was based on a macroeconomic hypothesis that Milton Friedman had proposed, which is that the volatility of inflation was actually the thing that we were most concerned about when we were talking about business cycles. And it's kind of interesting to think about that today when we really don't know whether inflation's a problem going forward or not. But in any case, so I designed the ARCH model to answer that question, and then only after time went by did it turn out that it was such a useful tool for financial applications for many of the reasons that you described, but it was a tool that was designed with a different purpose.
And Rob, did you have an inkling when you first did it for inflation that, wait a minute, this has broad sweeping applications and I can do the next thing, volatility? Or is that something that was suggested to you by others? How did you actually have the evolution from the original premise to the one which, of course, has become the really stock and trade and the famous modeling?
Well, I knew it was a good idea from the beginning, but I didn't realize how broadly it would be useful. In many respects, volatility was not actually a goal in itself in much of the modeling that I've done. It was, or in the development at the early stages, it was sort of a byproduct. You wanted to give a better estimate of something or other, and you needed to correct for the volatility, rather than thinking of the goal as being the volatility. And so I started getting invited to finance meetings to talk about volatility models and correlation models and so forth. And then as I saw the range of models that people were using, I became much more aware of how much this model could offer, because not only did it give you a sort of simple approach to the problem, but also gave you a structure that you could enrich in lots of different ways and make the model much more responsive to particular institutional features that you think were important, or co-movements between assets and lots of other things. So just by sort of recasting the problem, all of a sudden there was a lot of things, a lot flowed from that.
Yep. I suppose that with a lot of things, you basically had the market telling you what was important to them. And as you attended these conferences and you kept on getting comments and requests, it sort of was born out of the demand for having this kind of research, and then you responded to it.
Exactly. I would have people telling me, you don't realize it, but this is very important what you're doing. And I'd say, I'm glad to hear it.
That seems to be the way with a lot of academic research that we hear, especially the ones that are applied to finance on a regular basis, that they start off studying some other disparate area, and then slowly they learn of the practicality of it in the financial realm, and so they get pulled into that direction whether they wanted to or not, because there's just so much demand and so much need for this type of research in this field.
Right.
Well, I hope we can follow in your footsteps, Rob, because we've got a lot of people saying, gee, it's about time you came out with some product that measured realized volatility instead of just implied. And we're trying to respond to the marketplace. So if we have 1/10 of the success that you have, we'll be very happy.
Well, I think volatility is on the top of lots of people's lists of interesting products and interesting financial features. So,
what do you think about that? As someone who has been at the forefront of volatility research for many decades now, I won't say how many to protect your age, but for quite some time, and to see now just the explosion of adoption and interest in volatility, not just in the typical sectors of, institutional variance swap traders, but even in retail with the explosion of volatility products and interest now. And every time there's a market movement up or down of anything larger than 1% or so, we see quotations of volatility in the major headlines of publications around the world. Could you ever foresee volatility becoming essentially a household word when you first got into this realm of research all those years ago?
Certainly not at all. And I think really the financial crisis has increased our interest in it dramatically, partly because volatility was a little bit boring and low before the financial crisis, and partly because we recognize how valuable it would have been to have some part of your portfolio positioned in volatility during the financial crisis. And so it's hard to imagine a future market downturn or market disruption of any kind that isn't happening at the same time as high volatility. So it's a very natural hedge to think about.
Now, I'm sure I can hear, actually, as we're recording this, I can hear some of our higher-end listeners saying they want to, talking to their screens and shouting that they want to get more into details on some of your models. And, so let's dive into them a little bit then. And, of course, the Arch model excels, I guess you can say, in looking at financial time series that have that unique phenomena or that unique exhibiting of the time-varying volatility clustering. So that volatility is very strong and very evident in one section of the time series, then it tends to quiet down a little bit in another area of the time series, which is essentially reflective of a lot more of what we see in the real world with the markets. And so the Arch and the Garch models tend to work very well in those areas. But there are obviously other areas where Arch and Garch, their applications tend to fall short a little bit. So why don't we talk a little bit about those, too, on some of the areas where you found that the time series analysis and using Arch and later Garch haven't been as applicable as maybe you hoped they would be?
My feeling is, first of all, it's extraordinary how common volatility clustering is when you look across all different kinds of asset classes. It's really a consistent feature of almost all financial markets. And consequently, Arch and Garch models, which are pretty good at modeling volatility, mean reverting kinds of volatility clustering, is a great tool. And I want to say that first. Now, you asked, under what circumstances does it not do so well? Well, first of all, the Arch and Garch models are extremely simple. They only look at past information on this particular asset and try to forecast future volatility based on that. So, for example, a Garch model doesn't know when there is going to be an announcement. And so insofar as volatility is often based on scheduled announcements, either earnings announcements or macroeconomic announcements, it doesn't have any way of knowing these are coming up. It doesn't know that there's an election coming up. It doesn't know, that there is a peace conference in some war somewhere. So there are lots of things like that that are immediately missed by Garch-style models.
That's an interesting point. And I think a lot of people who have become very reliant on these models in the modern financial realm tend to sometimes overestimate those areas.
You might wonder, what's a good way to think about that? So I think one of the things I like often to do is to compare Garch models with implied volatilities. And when they're different from each other, and basically they are fairly different at the moment, those differences can be attributed to a couple of different aspects. One would be this kind of information thing. What do options traders know about the future that a Garch doesn't know about? So are options traders looking forward to some particular event, and how many vol points is that event really likely to produce? So you can think about the spread as being a way of measuring how important are the future events that are being forecast by the options traders. But the second thing that makes this spread bigger would be risk aversion. And so there is a lot of risk aversion in options prices that's not in the realized volatility. And consequently, when risk aversion is high, you expect to see these spreads being bigger. So there is so I think an option trader or a volatility trader needs to think about these two features as ways of understanding those spreads.
I think it's kind of interesting that you mention reaction to news and to events, because if you look at graphs, as we can talk about in a little while, VLab and the Volatility Institute, I know the listeners will be very interested. You can look at your ongoing predictions of future volatility using, as you mentioned, just past historical information, and you can overlay implied volatility, which obviously is derived from options prices. You see a similarity of the shapes of the ongoing moving averages, of course, but you notice two things, at least I do. One is this continual spread that we talked about in previous shows, where there is the risk premium and where implied volatilities most often trade with a bias in terms of estimate, 3-4 percentage points for equities. But you also see something that is interesting to me, and that is when some sort of news event or some event comes in, you see the very quick reaction and the spike in implied volatility that often simply doesn't materialize with the Arch and Garch forecast. And that's not at all to disparage them. In fact, from my way of thinking, it might even be better, because I tend to see very often an overreaction on the part of options traders who are trying to assess this new information, and nothing says that they do a spectacular job of it all the time. So it seems to me that there are plenty of instances where there'll be this kind of a spike in a reaction to an announcement or news, but where eventually, when volatility plays out and we get to grade, if you will, the forecasting capabilities, we find that the implied very often doesn't do a better job than the Arch and Garch models. Any comments on that, Rob?
I actually find it quite informative often to see how much the Arch and Garch models jump with news events. And I guess it's common that they don't jump as much as options implieds, but I think there are other situations where they do jump as much as option implies. For example, I was at a conference the day after the Japanese earthquake, so we looked to see what VLab had to say about the Nikkei volatility, and it showed it it went up by, I think, 10 vol points or something. I don't remember exactly what it was in one day. So these models actually have the ability to move very fast when there's a large piece of information coming through the equity price movements, particularly when it's a down move in the equity prices. That's very influential in the volatilities.
Since we are talking about the Volatility Institute and the VLab, we might as well explain those to our listeners. You have indeed founded the Volatility Institute over at NYU Stern, and as a component of that, you have launched the VLab, which does a lot of interesting studies and has a lot of interesting models into the world of volatility. So why don't you tell our listeners a little bit more about both of those, the Volatility Institute and, of course, what you're doing over at the VLab.
Thank you. That's great. So the Volatility Institute is a part of the Stern School of Business at New York University. I direct it, and we have academic and practitioner programs that we run here, conferences and a website with working papers and collaborators around the world. And I think one of the innovative things we do is we have the VLab, which actually perhaps comes from my physics days. It stands for Volatility Laboratory. And the question is, how do you think about a scientific approach to volatility? And that's what the VLab is supposed to be. So the VLab produces estimates of volatilities and correlations, and now some long-run risk measures and systemic risk measures for hundreds of assets every day, and forecasts what future volatilities are going to look like. And you can find it if you Google VLab at NYU, you'll find it right away. The website is actually vlab.stern.nyu.edu, and it gives plots of several different volatility models for each asset, so you can sort of see how they compare. It has the VIX in it, so you can compare that with other kinds of realized volatilities. It has some measures that are range-based, some measures that are based on sort of experimental volatility kinds of models. And it is a great way to see what these models do in real time.
Now, of course, part of your work over at the Volatility Institute is to provide long-term forecasts for some of the indices and products that Volex is putting together and launching. So why don't you tell our listeners a little bit about those too? You're actually providing the forecasts for their realized volatility products going out 3 months and beyond.
Yeah, so we have this approach to forecasting volatility, which I think is potentially quite useful for traders in the volatility contracts that the Volex is trading. So what we do is we calculate and forecast every day the volatility that would be expected, both starting today and going out, say, a month or a quarter, and also starting whenever the contract opened and going to whenever it closed. So in that case, some of the volatility has already been observed and realized, and some of it has to be forecast. And then you put those two together and you get an estimate of what the settlement price would look like if it settled today at this forecast. So I think this is a useful way of understanding sort of what a forecast of these closing prices might look like.
And if I can jump in for a moment, if listeners would actually like to see this online, just go to the website volex.us, and in the data section from the pull-down menu, just go to the Volex series, and you will find both the backward-looking historical calculations of 1, 3, and 12-month volatility, but then you'll find, if you will, the kind of mirror image going off to the future of these forecast vols that Rob has just alluded to. So we think it's a really fine tool for traders and researchers to try to look at these values. And then the second part that he mentioned is what we're referring to as the G-vol, or the modified Garch volatility estimate of the actual terminal price of the contract. So if you're trading a volatility contract, as Rob mentioned, you might be already into that calculation or realized volatility period whereby some of the data has already been logged into the formula, and we're actually starting to calculate the partial realized volatility, say, halfway into the expiration. What we do in that case is we combine the Volatility Institute forecast for the days that are left of volatility, and we throw in the days that have already been achieved or logged into the formula, and in that manner we get what would be the composite, or a forecast for what the actual final volatility will be, the settlement price on expiration day for the particular contract that's trading. I don't know if this has ever been done in the annals of exchange-traded products, where that kind of aid to the trader and that kind of research is actually disseminated on a daily basis. So we're really very excited about that.
You know, I was perusing the Volatility Institute website earlier and preparing for this show. One of the things I came across I thought was very interesting, and you mentioned systemic risk earlier, and you are actually disseminating daily rankings of systemic risks and the firms that you feel in the financial sector that are posing the greatest risk of meltdown in some of these times of crisis that we might be seeing going forward. And I thought that was a very interesting application of some of your research, and to compare that to what's going on in the CDS world right now and what they're valuing and some of the different criteria that you're using in some of your models, because I think your assumptions are very interesting, that the fact that so many of these firms now that are facing and posing systemic risk, they have the hand of the government involved there, and so that tends to throw off the definition of both bankruptcy and of a liquidity event. So then what is the CDS really measuring and protecting you against in that sense? You tend to put a lot of focus then on the market and what the market can analyze. I thought that was a very interesting application of some of your research into actually attempting to quantify what level of risk these firms pose in a catastrophic market downturn.
Yes, we've had a lot of positive feedback on this. We're careful in collaborating a lot with various regulators who are quite interested in our methodology and have their own methodologies, which they're comparing and contrasting with the way we do it. Ours, of course, is all publicly available information, actually primarily equity prices, and we think actually that equity prices are probably less contaminated by potential bailout considerations than CDS prices, but they both have important information about firm risks. But in fact, we're of course not interested just in firm risks. We're interested whether the risks that the firm faces pose risks to the economy as a whole, and that's exactly one of the things that we think will make the financial system more stable in the long run if we can get good but not punitive regulations to improve the functioning of the market.
Since you brought up regulators, I couldn't bring you on Options Insider Radio Network and not at least ask you about your work on the regulatory front. This is a topic we cover quite a bit on many of our other shows, but I know a lot of our listeners on these shows will be interested in it as well. And you've been a very active speaker recently on Dodd-Frank. Of course, you were also part of the SEC advisory committee that was formed in the wake of the flash crash. So first off, since your committee obviously proposed a series of improvements and recommendations, are you happy so far with the way your recommendations have been implemented and handled?
By the CFTC and SEC?
Yes.
Yes. Well, I think, first of all, this is an extraordinarily busy time for them. They are trying to write rules in lots and lots of different dimensions of the Dodd-Frank bill beyond the question of the flash crash and its implications. They have been very supportive of our recommendations and are actually working to implement several of them at this point, and I think several others are on their research agenda that they're thinking about. Our feeling is that what we learned from the flash crash was that there is an issue with liquidity supply, which seems to be somewhat fragile when markets become extremely turbulent. And I think that's a challenge for regulatory, for market design. And it's a challenge for everybody who is writing code to do high-frequency trading. How is this really going to be handled in basically the computerized trading systems, the algos, and how is it going to be handled through a variety of potential regulatory adjustments? And I don't think we've really solved those problems. We've put in circuit breakers. There's talk about some limit up, limit down kinds of methods to kind of stop the panic selling, or I suppose buying. But I think there's still more work to be done on how to implement those.
Of course, you've addressed the key issue that is concerning and just everyone in the options market is grappling with these days, which is how to indeed provide incentive for those liquidity providers and the traditional market makers that have been, a pillar of the options market for so long, while at the same time being able to attract and incent these new class of, I guess you can call them quasi-liquidity providers like the high-frequency traders that you mentioned, who are flickering and streaming quotes on a lot more of a regular basis and are providing, in some sense, some sources of liquidity. But as we saw on May 6th, those sources quickly dried up, and there were no more bids and offers to be had on a lot of the high-frequency guys, whereas the regular market makers were left trying to deal with this. And as the exodus from the market-making community continues, that's becoming a larger and larger problem. For example, I'll be heading down to the Options Industry Conference in a little over a week to discuss these issues and many more, and this is definitely a key issue that we're grappling with, so any insight you could offer by any means, because how to incent traditional market makers while still allowing room for new entrants to participate and to acquire some of those benefits is, as you said, a very delicate balance I don't think anyone has found a way to strike yet.
That's right, I think.
And before we go, because I know we could talk to you for hours, and I certainly could, and I'm sure Don could as well. Just overall right now, obviously you've been doing a lot of speaking out on Dodd-Frank and counterparty risk and a lot of other things that have been happening. Obviously Dodd-Frank is still in flux. There's a lot of key elements that have yet to be implemented or even agreed upon.
Right.
What is your opinion of the progress so far and of the state of the legislation and the regulation so far?
Well, I was very pleasantly surprised by how much was put in this bill in the first place a year ago. I thought that Congress worked very hard and made lots of progress in reducing lots of places where the financial industry was working against itself, where there were externalities and various things. That being said, the details are still being formulated, as you know, and a lot of these details are getting a lot of pushback. There is a lot of question as to whether the derivatives business is really going to get moved onto the swap execution facilities in majority of it, or just a small part of it. The collateral issues seem to be more serious than I would have expected. Really, I don't see why there aren't going to be institutions that will lend a company collateral based on their own reputation without it costing millions of dollars the way the end users think it's going to. And so I think that there are a lot of things still being worked out. It probably is going to ultimately end up weakening the Dodd-Frank bill a little bit, but probably will still be a very useful contribution.
That's great, Rob. Thanks so much for all of your insights. And before we wrap up and let you go, I did want to give you an opportunity to tell us one more thing, and that is, although VLab is certainly an integral and extremely important part of the Volatility Institute, it really isn't the only part. And so I happen to know this, but I think our listeners would be interested. Tell us a little bit about the Institute itself and some of the academic programs that are going on there, some of the distinguished faculty and the research that they're doing. And for those who may have the opportunity to be in the New York area, some of the events that you hold on a regular basis, such as the all-day conference that I just had the great fortune to attend and brought some of the great academics from around the country and actually the world to discuss their latest research.
Well, we have a series of conferences, some which are formal and some which are casual. There is a volatility conference that we do every spring, which brings leading academics and practitioners to NYU, and it's open to academics, practitioners, graduate students, and so forth. And I would encourage anybody who's listening to stay tuned for the next one, which will be next spring. In the meantime, we also have a series of other conferences that go on. We have the sort of internal research days, which are a chance for the faculty at NYU to talk about some of their research. We have jointly with the Solomon Center and the Derivatives Research Project at NYU, we've got conferences on, there's a conference coming up on microstructure, there's a conference coming up on, I think there's a credit risk conference that's going to be in, actually this one will be in London, I think, this year, but it's back next year, and a series like that. We also have a lunchtime lecture series, which called the Quantitative Finance and Econometrics. So it's kind of a quant style lunch conference, which happens more or less once a month, and then we post things on the website, and we're working closely with the new Society for Financial Econometrics, which is actually housed in the Volatility Institute, and which is called SOFI. SOFI has a series of conferences that I think your listeners, again, might find interesting. We have our 4th annual conference coming up in about a month in Chicago, with John Taylor giving the keynote speech, and that's following meetings in New York, Geneva, and Melbourne over the last 3 years. So it's a global society, which is, I think, become very successful. So there's a lot going on, and just visit the website, take a look around, come by.
Well, Rob, that's certainly a lot of interesting things for our listeners to be aware of, and we'll certainly have to post links to all of those various events on our show notes so our listeners can find them and register for them. And indeed, if they're in the New York or Chicago areas coming up, they can actually attend some of them, which should be interesting. But I just wanted to thank you again for coming on the show, Rob. This has been fantastic, and I hope we can get you on again down the road to maybe dive a little bit deeper into some of your research, as well as some of our other shows on the network, which are more options, market, and industry focused, where we can discuss more of the regulatory and other areas where you're very active these days.
Thank you.
I'd like to add my thanks, Rob. Everybody knows that the Volatility Exchange is trying to become the place where everybody goes to trade realized volatility. And by the same token, listeners should know that the place everybody should go to learn about the cutting-edge research in volatility is, in fact, the Volatility Institute. It's our great pleasure to be partnered with Professor Engle and with NYU Stern and the Volatility Institute. We look forward to a long collaboration. Again, it's been an honor to work with you and with your colleagues, and thanks so much for coming on today.
Thank you.
All right, and that's going to do it for the Volatility Viewpoint segment, and that's also going to do it for this unique episode of Volatility Views. We changed up the format a little bit, but given the content, I don't think our listeners will be upset at all, and we really want to thank Professor Engle for coming on and spending some time discussing his research with us, and we'll definitely hope to bring him on again where we could dive into his research a little more and talk about some of the other interesting developments he has going on over at the Volatility Institute. And of course, if you want to interact with Don or myself, or maybe post some questions for future guests, who knows what we'll have coming up on future episodes of Volatility Views, then surf on over to theoptionsinsider.com and then post your question in the Volatility Views forum. You can also send us a question via Twitter at twitter.com/options or twitter.com/Volex_info. I almost said Volex US, but Volex_info. Right. And you can also, of course, shoot us an email at questions@theoptionsinsider.com. Or what's the general email over there at Volex again there, Don?
info@volex.us.
Okay, that's the general one. So hopefully someone checks that one on a regular basis, I'm assuming.
Right.
Maybe put Volatility Views in the subject line or something like that, so they'll know that that's for this show, and Don will get on it right away. And then, of course, we also have the voicemail 312-544-9356. Give us a ring, leave us a voicemail. If it's interesting and exciting, we just might play it on the air. And that's going to do it for this episode of Volatility Views. I hope all of our listeners have a profitable and interesting trading week, and we'll see you back here again next time on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.